All right, now let's talk about the sales side of it. Now we're the seller selling it to our customers. Now, what kind of special transactions happen here? And they're pretty much the same as what we talked about in the purchasers, but we're just looking at it from a different side now. So the first one, I'm going to continue on with the transportation because, again, those are really two parts. We talked about FOB shipping point in the last video. In this one, we're going to talk about FOB destination, which is the other side of that. So again, transportation costs. The responsible party paying for the freight cost depends on which party assumes this risk. That's the exact same thing that we talked about last one. If the risk of loss during the transit is assumed by the seller, meaning it ends at the destination point, then the shipping terms are known as FOB destination. So the seller obtains the risk, the liability of loss, up until the point where it's delivered. That's going to be considered FOB destination, and the seller is the one that's specifically paying for it. So again, if you're looking at this, seller, transportation, and buyer, and you have, again, the shipping point and destination, and it still follows that way, if it's the seller responsibility, they obtain the risk from the point of shipping until it is delivered at its destination. Now, this one's a little bit different when you're dealing with the journal entry, because at this moment, we were able to add the cost into the inventory to the last one because we're the buyer and we haven't sold that inventory yet. So we just add it into the inventory and then expense it when it's sold. This one, we can't do that because we've already sold the inventory. That's why we're sending it to its customers because they bought it. So I can't add it to inventory. I'm actually going to have to expense this in its own account. And I'm just going to call it something like delivery expense or transportation expense. More times than none, it's delivery expense for that amount. And then again, cash. So if it's FOB shipping point, we're going to put it into inventory if you are the responsible party. If you're not, you do nothing. If it's FOB destination and you're the responsible party, we put it into delivery expense. Okay? That's the transportation cost side of it. Now let's talk about something that we talked about again. Another one, we have sales return. We talked about purchase return last one. This one's dealing with sales returns and allowances. So again, a return is a merchandise a seller sales back or sales and then is brought back. So our customer's bringing it back to us. The effects of the return are the opposite of the original with one exception. And it really depends on kind of, who's, I guess you would say who's teaching this too, but I'm giving you kind of the book version of this, the more accurate version of this. So if we're going to look at a purchase, this is what it would look like as the original purchase. Cash and accounts receivable, COGS, and then we would credit sales and inventory. That should look familiar from when we talked about how to record or recognize a sale of inventory. Now, what would it look like if they brought that back? Well, it would look exactly the opposite of, with one minor difference, and that is it would not be sales revenue. We're going to claim this one as sales returns and allowances. This is kind of a side account that lets us know, okay, this is what we sold and this is what was brought back. That way we can kind of show the whole picture to the investors that, yeah, we did really sell this, but we had this brought back. And so that's why we use a different account there instead of sales revenue. But then the rest are the same. Inventory becomes the debit, and then you have cash and AR, whichever one you used is going to be the credit, and then you're also going to have cost of goods sold as the final credit. So again, we're just flipping those, but changing sales revenue into sales return and allowances. If you're doing this for an allowance, much like the last one, it's going to look very similar. An allowance is a reduction in the cost of defective or unaccepted merchandise that a seller issues. So this time we're giving this to our customers, but it's not going to be the exact opposite. Okay, there's the original again. That doesn't change. So again, cash, sales revenue, COGS, inventory. Those are our two debits and our two credits. But this time, if we give an allowance, we're not actually getting the inventory back. All we're doing is taking it off of our revenue. And so for this one, this would be sales returns and allowances for that amount, and then it would be cash or accounts receivable, however they pay. Notice I'm not touching COGS, I'm not touching inventory because we gave the allowance. They keep it. We're not doing a thing. We're not getting a thing back, I should say. So last one, we have sales discounts. Again, much like we had purchase discounts, we have cash discounts. Creatively, this is the cash discount applied to sales, just like the last one was applied to purchases. It's going to look the same. It's still going to look the same. It's still going to mean the same thing. 2 is going to tell us what the discount is. 10 is going to tell us the discounted period. The 30 is going to tell us when we have to pay the entire thing off by. If we're going to look at this one, for the receivables amount paid within the discounted period, the sales discount account is increased by the discount amount. And so let's look at this one. So we have, if we're going to do this and we were getting paid this, so one of our customers is paying off our discount, we have cash because they're paying it off, and that's going to be the account amount minus the discount. So that's what they're paying off. They're not paying off the entire thing. And then we're going to have the sales discount. Again, that's telling us what the discount amount is. Notice I'm not putting it into sales revenue. It'll affect revenue, but I'm putting it into discount specifically because, again, I want to show what I did sell in total in revenue, and this is what I had to take off because of a discount. And then finally, I'm going to take it out of my accounts receivables as a credit for the total amount, receivables amount. So that's what a sales discount would look like. And that's everything from the special inventory sales transactions from the sales side. So we've done both sales and purchase. Appreciate it.